Welcome to the Deep Dive. Today we're going straight into a recent document filed with the U.S. Securities and Exchange Commission.
That's right.
We're taking a close look at Achr Aviation Inc.'s quarterly report. This one's for the period ending March 31st, 2025.
Yep, the latest 10Q. And our goal here really is to pull out the key insights from this filing.
Exactly.
We want to help you understand where Achr stands financially right now and what their plans look like going forward, in this whole advanced aviation space.
Right. We'll look at the money side, what they're spending on, their immediate plans, but keep it accessible, not too bogged down in jargon.
Absolutely. So this is all based on that Form 10Q. It's a standard quarterly report, gives you the balance sheets, income statements, cash flow.
All the usual financial plumbing, plus notes with more detail. Okay, let's dive in. Achr Aviation. What's their core business? Remind us.
Okay, so Achr is an aerospace company. Their big focus is on electric vertical takeoff and landing aircraft, eVTOLs.
eVTOLs.
Right.
Right. These are the electric planes that take off like helicopters.
Exactly. Vertical takeoff and landing, but they fly like a regular plane once they're up, and all electric.
So very future-focused tech.
Definitely. They've got two main business lines planned out. First is commercial. That means selling the aircraft themselves, like their Midnight model.
Okay.
Selling related tech and services, and also, this is interesting, a direct-to-consumer aerial ride-sharing service. They call it Achr UAM.
Like an air taxi service you'd book.
Pretty much, yeah. In specific cities, that's the plan. Then there's the second area,
Which is
defense, selling these next-gen aircraft and tech for, military and government uses, defense applications.
Got it. Commercial and defense. And they're actually building these things now. I saw something about a factory.
Uh-huh. Big news there. They finished their high-volume manufacturing facility. They call it ARC, down in Covington, Georgia. That was back in December 2024.
Okay. Finished in December.
And crucially, they started production in that facility in the first quarter of 2025. So Q1 this year.
Wow. Okay. So production has started. That's a major step.
Huge step, moving from just design and development to actually building aircraft at scale.
But are they actually selling them yet? Making money from sales?
That's the key point right now. As of the end of March 2025, this report confirms they are still pre-revenue.
Pre-revenue.
For both the commercial side and the defense side. Lots of investment, lots of building, but no significant sales income flowing in just yet.
Right. So huge potential, but early days in terms of actual business operations. Let's look at the financials then. How's their cash looking?
Okay, cash. This is pretty interesting. Their cash and cash equivalents actually went up. By March 31st, 2025, they had $1,030.4 million.
Over $1 billion in cash?
Yep. That's up quite a bit from the $834.5 million they had at the end of 2024.
Wow. How did that happen? We'll get to that, I guess, but that's a strong position for a pre-revenue company.
It really is. It gives them a significant runway, breathing room for operations and development without immediate panic about funding.
Makes sense. What about total assets? Did that grow too?
It did. Total assets reached $12,214.6 million. That's up from about $1,001.2 million at the end of last year.
So the company's overall value on paper is increasing, likely tied to that factory and other investments.
Yeah, that seems likely. Investments in property, plant, equipment, all that foundational stuff.
Okay, so lots of cash, growing assets,
Yeah.
but they're not making sales yet. So are they profitable? I assume not.
No, not yet. The report shows an accumulated deficit of $1,779.0 million, almost $1.8 billion.
Oof, that's a big number.
It is, but you have to see it as the total sum of their investments over time to get to this point. R&D, building the factory, hiring people. It's pretty standard for companies in this kind of deep tech, long cycle industry.
Right, typical for this stage. But is the loss getting worse or better?
Actually, there's a positive trend there. Their net loss for just the first quarter of 2025 was $93.4 million.
Okay, and how does that compare?
It's better than the same period last year. In Q1 2024, the loss was $116.5 million. So the loss narrowed.
So still losing money, but losing it at a slower rate. That's
Yeah.
progress, I suppose.
Exactly. It suggests maybe better cost control or efficiency starting to kick in, and that's reflected in the loss per share, too. It went from $2.36 last year to $17 this quarter.
Okay, so the burn rate seems to be improving a bit. Where is most of the money being spent then? R&D?
You guessed it. Research and development is the big one. $103.7 million spent just in Q1 2025.
And how does that compare?
That's up 24.2% from Q1 last year. The report says it's mainly hiring more people and buying materials for, developing the technology.
Makes sense. You got to spend money to develop these advanced aircraft. What about the other big expense category, general administrative or G&A?
That one actually went down quite a bit. G&A costs were $40.3 million for the quarter,
Down from what?
down 31.3% from Q1 2024 when it was $58.7 million.
That's a pretty big drop. Why did G&A go down so much?
The main reason given is lower stock-based compensation expenses this quarter, specifically related to some founder grants.
Ah, okay. Stock stuff.
Yeah, and there was also some kind of one-time charge last year that didn't repeat this year, so a combination of things bringing it down.
Interesting. So R&D is up, G&A is down. The report also mentioned other income and interest income being up.
Yeah, that was noticeable. Other income net was $42.0 million.
$42 million. That's a lot. Where did that come from?
It was way up from $20.6 million last year. The filing says it's primarily due to changes in the fair value of their warrant liabilities.
Okay, warrants. We need to circle back to what those are exactly. But basically, accounting adjustments related to warrants gave them a boost
Essentially, yes. A non-operating gain, basically. And interest income was up too.
because they have more cash.
Precisely. They earned $8.7 million in interest in Q1, up about 64% from last year, just because they're holding more cash that's earning interest.
So even without sales, that higher cash balance and the warrant changes are actually contributing positively to the bottom line, or at least reducing the loss.
Right, offsetting some of the operating costs.
Let's talk stability. Do they have enough cash to keep going? Management seems confident.
They do. The report explicitly states that management believes their current cash pile is enough to fund operations for at least the next 12 months.
Okay, so they see a runway for the next year based on the cash they have now.
That's the message, yes. Provide some reassurance.
Any major debts we should know about, besides the usual operational stuff?
They do have a specific loan mentioned $65.0 million from Synovus Bank,
What's that for?
tied directly to building that manufacturing facility in Georgia. And the report says it was fully drawn down as of March 31st.
Okay, so debt specifically for that big capital project. Makes sense. And how did they get that cash balance so high recently? You mentioned financing.
Yeah, they've been active. In February 2025, they did a registered direct offering, basically sold shares directly to certain investors.
How much did that bring in?
Net proceeds were about $289.5 million. So a big chunk right there.
Almost $300 million. Okay.
Plus, in January, they finished up a previous deal, part of a PIPE financing with Stellantis. That added another $9.6 million net.
PPE, private investment in public equity.
Right, so those two things really boosted the cash. They also have an at-the-market or ATM program.
Where they can sell shares gradually into the market.
Exactly. But they didn't sell any shares through that program in Q1 this year. They still have about $47.5 million available under that if they need it later.
So they topped up the tank significantly through those offerings. What about longer-term funding? What do they anticipate?
Well, looking ahead, they say future needs depend on R&D pace, how fast they scale up manufacturing, G&A costs, and eventually sales and marketing spend.
Standard stuff for growth.
Pretty much. They expect funding to come from the cash they have now, potentially pre-delivery payments from customers.
Like the one from United.
Exactly. And then future equity or debt financing if needed. It's the typical playbook for a capital-intensive growth company.
Okay, let's talk about those partnerships.
Yeah.
United Airlines seems like a huge one. What's the deal there?
It's very significant. United placed a conditional purchase order. Conditional is the key word.
Right.
For up to 200 Achr aircraft, plus an option for 100 more. And importantly, Achr already received a $10 million pre-delivery payment from them.
$10 million up front. That shows some serious commitment from United, even if it's conditional.
It does. But again, Achr hasn't recognized that $10 million as revenue yet.
Why not?
Because the conditions haven't been met. Things like getting the aircraft fully certified by regulators. The sale depends on hitting those milestones.
Got it. And United also got warrants as part of this deal.
They did. Warrants give United the right to buy Achr stock at a set price later on.
Okay.
These warrants vest, meaning United actually gets the right to use them based on hitting milestones. Receiving that prepayment was one milestone. Others include the anniversary of the deal amendment and, crucially, actual aircraft deliveries.
So United has an incentive to see Achr succeed and deliver those planes. Their warrants become valuable if Achr hits its targets.
Exactly. It aligns incentives.
What about Stellantis, the car maker? What's their role?
Another key partner, Stellantis has a manufacturing and collaboration agreement with Achr. They're bringing their manufacturing expertise to the table.
And they've invested money too.
Yes, $150 million dollars through something called a forward purchase agreement back in July 2024. Plus, Stellantis also has warrants
More warrants. How many?
to purchase up to 15 million Achr shares.
And how do those vest? Same kind of deal.
Similar concept, but tied to different things. Their warrants vest based on how long the collaboration agreement runs, and also if Archer's stock price hits certain targets.
Okay, so tied to the partnership's duration and Archer's market performance, it really looks like they're leaning heavily on these big strategic partners.
It seems like a core part of their strategy, absolutely. Getting demand locked in with an airline like United
Mhm.
and getting manufacturing help and investment from an automotive giant like Stellantis, it helps de-risk things.
Yeah, spreads the load.
Mhm.
Okay, let's shift gears a bit. Stock-based compensation, you mentioned it was down in G&A. What's the overall picture?
Right. So total stock-based comp expense for Q1 was $30.1 million.
Down from what, about $40 million last year?
Yeah, down from $40.7 million in Q1 2024. And that $30.1 million breaks down into $11.1 million for R&D folks and $19.0 million for G&A.
Okay, and this comes from their equity plans.
Mostly, yes. They have a main 2021 equity incentive plan, lets them grant options, restricted stock units, RSUs, things like that, and an employee stock purchase plan, the ESPP, where employees can buy stock at a discount.
Standard tools to attract and keep employees in tech,
Very standard. Both plans also have evergreen provisions.
meaning they automatically refresh the pool of shares available each year.
Up to a certain limit.
Hmm.
The report notes the share reserves for both plans were increased on January 1st this year.
And those founder grants you mentioned earlier, the RSUs.
Right, those were specific grants made to the founders when Achr went public via that merger deal. They have complicated vesting schedules based on performance and market conditions over 7 years. Part of the reason G&A stock comp was lower this quarter relates to how those specific grants are accounted for now.
Okay, that clarifies the stock comp piece.
Mhm.
Now let's circle back to those warrant liabilities that popped up in other income. What exactly are these?
Okay, warrants. Think of them like long-term options to buy stock at a fixed price. Achr has two main types outstanding, public warrants and private placement warrants.
They go private.
The public ones trade on the NYSE, ticker is ACHRWS. Because they trade publicly, their value is easy to see. It's a level 1 measurement.
Okay, what are their terms?
Exercise price is $11.50 per share, and Achr can redeem them, basically force holders to exercise or lose them if the stock price stays above $18 for a while.
Gotcha. And the private placement warrants, how are they different?
These don't trade publicly, so their value isn't directly observable. They're level 3 measurements.
Meaning Archer has to estimate their value using models.
Exactly. They use a Monte Carlo simulation. It takes into account things like the current stock price, the strike price, time remaining, interest rates, how volatile the stock is expected to be.
Lots of assumptions go into that value.
Right. And changes in those assumptions, especially stock price and volatility, can cause the calculated fair value to swing around. That gain of $17.0 million in other income this quarter, that came from a decrease in the calculated fair value of these private placement warrants.
So changes in the market's view of Archer, reflected in its stock price and volatility, directly impact their reported income through these warrant liabilities.
Precisely. It's an accounting impact driven by market factors.
Okay. The report also mentioned legal stuff briefly. Anything major?
There's ongoing class action litigation in Delaware. It relates back to the merger deal when Achr went public, merging with Atlas Crest Investment Corp.
What's the stats?
Achr filed a motion to dismiss the case. There was a hearing on that motion in April 2025, just after this reporting period ended. But as of the filing date, the court hadn't ruled yet.
So something's still pending.
Yeah.
Common after these kinds of deals, but worth keeping an eye on.
Definitely. Standard post-merger stuff sometimes, but you watch it for potential impact.
And finally, the usual note about risk factors.
Yep. Standard disclaimer. Investing involves risks, especially in a new industry like eVTOLs. They point you to their full annual report for the detailed list of risks. Always important to remember.
Okay, good stuff. Let's try and wrap this up. What are the big takeaways from this Q1 2025 filing for Archer?
All right, big picture. Achr is clearly making tangible progress. Starting production at the ARC facility is a huge milestone.
Yeah, that seems key.
They've significantly strengthened their cash position thanks to that recent financing. Gives them runway. The strategic partnerships with United and Stellantis look crucial to their plan.
Right. Locking in potential customers and manufacturing help.
Exactly. Now, they are still pre-revenue and operating at a loss. That's expected. But the fact the loss narrowed compared to last year is uh, mildly encouraging, suggests maybe some cost discipline.
Okay.
On the other hand, you have factors like the warrant value fluctuations creating noise in the results and that ongoing litigation to monitor.
So progress on the operational front, strong cash, key partners locked in, but still burning cash and facing the usual hurdles of a development stage company.
That sums it up pretty well. The building blocks seem to be falling into place, but the road to actually certifying these aircraft, scaling production, and launching commercial service is still long.
Absolutely. And looking ahead,
Yeah.
you have to think about what comes next. Aircraft certification is obviously massive.
Political path.
And then building out those urban air mobility networks they envision.
Hmm.
How does that actually work logistically, economically? What are the biggest hurdles still ahead for them to really achieve that vision? This filing gives us a great snapshot, right? A detailed look under the hood financially.
For sure.
But the Achr story is definitely still unfolding, still very much in flight.